Hi, my name is Janine Colpitts, and I'm a CPA and tax manager at Kirkering Barberio & Company. I primarily work with business entities, and I also specialize in state and local taxation, or what we like to call SALT. I've been with the firm for 8 years, and I'm a married mother of 3. My family is a big support in my role at KB as a tax manager, and KB provides flexibility for a work-life balance. As a tax manager, I interact with clients on a daily basis doing tax planning, researching tax questions, or even problem-solving day-to-day activities. I love being able to work with clients and help with their tax solutions. My primary work focus is business entities, including C&S corporations and partnerships, and these entities file annual tax returns, and I'm going to show you some of the forms they file right now. This is Form 1120S, and this is a form that a S corporation files. An S corporation is a pass-through entity, and what that means is the income that is reported on the tax return passes through to the owner shareholder and is reported on their individual return. So the first page here is your P&L report. Essentially, it has your gross receipts, sales, cost of goods sold, and regular operating expenses, giving us our taxable income figure. Moving on to the second page, this is Schedule B. It has some, other pertinent information about the entity, the type of business, and whether they are reporting on a cash or accrual basis. There's some other questions here that need to be answered on the form, and brings us to the Schedule K, or shareholder pro rata income items. And these are the items that pass through to the shareholder on a Schedule K1 and are reported on their individual taxes. And on Schedule K continues on, and that takes us to our Schedule L, which is our balance sheet. And this is where our assets and liabilities reported and our equity retained earnings. The last page is our Schedule M1 and M2, or analysis of accumulated adjustments account. And it reconciles the difference between net income or book income prepared by the client, our tax differences, and overall taxable income. I also work on multi-state tax returns in addition to filing federal tax returns. And some people may not realize, but there aren't only federal tax returns, and most states have their own tax return and filing requirements. Some states even require businesses to file a tax return, but not individuals. For example, Florida doesn't require individual taxpayers to file a return, but corporate taxpayers do. And now I'm going to show you an example of a Form 1120 and F1120, which are the federal and Florida forms that are filed by a corporation. This is Form 1120. This is a form that U.S. corporate tax returns file, and it's different than the last form that we looked at, the 1120S, because corporations actually pay tax at the corporate level. So that's going to be your biggest difference that you see on this form. We have our same profit and loss items of gross receipts, cost of goods sold, and operating expenses. But here you see on line 31 that the corporation has a tax that it has to pay. And then moving on to the second page, we have some differences because there are dividends and special deductions available to corporate taxpayers and corporate entities. So moving on to the tax computation on Schedule J, we have, this is a separate page that we don't see on an S-Corp return, which is the calculation of the federal income tax. On the next page, we have the other information on Schedule K, which is where we indicate the cash and accrual and business activities of the business. Ownership information and some other questions, just like on the S-corp return, maybe a little different. And then as we come to our last page, we have our Schedule L, just like on the other pass-through entity return, which is our balance sheet and has our assets and equity and liabilities, and our reconciliation of income or loss per books and taxable income on the return. The difference here with our corporate taxpayers is that they are not finished when they file their Form 1120. If they're a Florida taxpayer, they are going to file Form F1120, which is the Florida Corporate Income and Franchise Tax Return. So as you can see, we have a similar income number here of the 1.4 million. You recognize that from the 1120 return that we just looked at. That's no different, but we do have some federal and state tax differences. And that's part of what I do in my job with multi-state entities, is identify the differences between federal and state tax provisions. So for instance, we have this add back for state income taxes that are deductible on the federal return, but they're not deducted on the Florida return. So they're added back to income. We also have some other federal differences here on the addition and subtraction line. And as we move on to the next page, we can look and see on line 18 that they are referring to code section 168K. 168K is the bonus provision, which is a federal accelerated depreciation provision. And Florida is one of the states that doesn't actually conform to that provision. So they add back the federal deductible depreciation and then recalculate what is allowable in Florida. So that's one of the many differences between the federal and states to show as an example. There's also what Florida allows, and Florida is unique in their treatment as allowing an exemption, a $50,000 exemption is offered to entities to lower the tax. So we also have to, as we see here, the corporate taxpayer has to pay tax to the state as well for the operations that they perform within the state. And as we move forward with the return and we look at the next page, there are also apportionment schedules, which are different on states, because businesses that have activities in multiple states have to determine where their federal income is going to be taxable according to their business location and operations. And there's a lot of factors that go into play, and those are probably conversations for another time, but these are just some of the examples of how businesses that are operating across multiple states have more complexities in filing, and the need for CPAs to offer guidance to help them know what's taxable and where, if they are operating across multiple states. The global marketplace has made multi-state taxation more prevalent for business owners. The internet has allowed businesses to broaden their customer base, and this is a huge benefit, but it comes with additional compliance. This is where we have a great opportunity to assist the client and provide guidance to comply with state tax laws. We need to keep current with the law changes in the news and follow thought leaders in the industry. I'm attending a training the beginning of February to learn more about the state impact of two recent federal law changes, the CARES Act and the stimulus bill. I enjoy having an opportunity to provide tax guidance to our clients. I review the client's state activities and determine if there's a filing requirement and what income should be reported. My team and I answer this type of question a lot, and we review the state activities with the client, learn more about their business industry. I do a lot of research of the state tax laws and build charts and matrices to assist with the performance of our work. Sometimes more complex client situations arise as well. I've worked with clients on extraordinary events where they sold stock or partnership interest in an entity with multi-state activities. Each state has different laws for taxing the gain on the sale, which affect the client's tax liability, and it creates more complexities on the return. And when I'm not working on client-specific items, I keep up with the current legislation changes and items to watch in the news. I subscribe to newsletters, listen to podcasts, and attend training webinars to keep up with the current events. For example, right now, I'm waiting to hear back about additional guidance from California on the Paycheck Protection Adjustment. The federal stimulus that just passed in December included a provision that allowed taxpayers to deduct expenses paid with the forgiven paycheck protection debt on the federal tax return. Remember, I said earlier that states have their own tax return and laws. Well, California is taking a different position than the federal, and they will not conform to the deduction as in the federal return. This creates complexities on the state return, and CPAs are seeking additional guidance from the California FTB to comply with this change. And another headline I'm following is something I find really interesting. Public Law 86272. This is a federal law enacted in 1959, and it addresses multi-state commerce. A lot has changed in the way business is conducted since the law was enacted, and the last revision was 2 decades ago. The Multi-State Tax Commission is currently working to update the language to address internet sales and expand definitions covering modern business activities. These were not common activities 20 years ago, so we need new guidance in line with the current marketplace. These are the things that keep my job interesting and relevant. The SALT segment is a new and growing niche, and I have an opportunity to be a thought leader in my industry while helping the firm and our clients.